What's up, guys? Welcome back to Talkin Options, where I teach you how to trade options, giving you a better option than the option that you had before. Bars. Last week we talked about call options, and that's one of the first option contracts that a lot of people learn and understand when they're starting to trade options. Well, today we're talking about put options. Put options are very important when we're talking about trading options because we like to use them to hedge our positions, especially the long put. When we're talking about long calls, that's a bullish position. Well, long puts is just the opposite. It's a bearish position. I am buying outright, saying that I believe this stock is going to go down. Now remember, when you buy outright, that is the most that you can lose. However, the upside to it is that you can gain unlimited. Now, a specific scenario where we like to use long puts is when we are buying stocks outright to hedge our position. So if I have some shares in Tesla, for example, but I see that Tesla is ranging to the downside, then what I would want to do is do a long put to hedge my risk. Now, a lot of you guys who are not familiar with options may be saying, why would I do a bearish position if I actually want Tesla to go up because I own shares outright? Well, it's because of the fact that we know that the market is going to range. So we're just hedging our risk. We are putting insurance. Remember, options is all about insurance. We're putting insurance on our investment. And so a long put allows us to do that. And we also, the good thing about it is that we can only lose what we paid up front. Now, the second one that we have is we have a short put. I like short puts. And the reason why I like short puts is because I am able to get to trade. I am collecting premium when I believe that a stock is going to be bullish. So short puts are just the opposite of short calls. I'm collecting premium, so that premium is the max that I can make. I can lose unlimited. However, with selling, remember, we have a higher probability of being correct. So with a short put, I'm saying that I believe that a stock is going to go up at a particular strike price. I, of course, have my expiration date and all the nine. Another reason why we like to use short puts is because we know that we have a higher probability of being correct. Remember, when you are selling, you don't have to worry about time decay as much as the buyer. But when you're selling premium, remember, time works in our favor in this case because we don't want as much movement to the downside. With a short put, we're saying that we believe the stock is going to go up. However, if the stock stays there or if it goes up, we profit in both scenarios. Where if you were doing a long position, you only make money if it goes in your particular direction. So what I'm going to do right now is I'm going to show you guys in the ThinkorSwim platform, long put and a short put. So in the last video, I used Chipotle as an example, so I gotta do it one more time. And the reason being is because I actually had a few people on Instagram who were asking me questions about options, and they were still a little bit confused on how you can use options to hedge your positions with stocks. And this is just a great trade setup, especially if you were a positional trader. So right now you're looking at CMG, again, that's Chipotle, and this is a weekly chart. So a weekly chart is showing you from October of 2014 all the way to October of 2019. And I made mention in the last video that there's these two massive moves to the downside that we saw in October 2015 and in 2017, and those match up with the fundamental news that we saw with Chipotle during that time, which was basically they had a massive breakout of E. coli. It was gross. A whole bunch of restaurants closed due to it, and even the CEO at the time, he even liquidated some of his shares, which sent the stock CMG crashing. And so the reason why I'm mentioning this before talking about long puts is, what if you actually owned shares in Chipotle during this time? What would you have done to hedge your position? You would have done this exact strategy if you knew about options, long puts. And it seems like we're going to have another good opportunity to use it. And the reason being is because even though we see Chipotle doing really well right now, I want to show you this Fibonacci retracement level that we have here. So as you can see, measuring from July 2016 to about the end of 2018, right now we see that, Chipotle's been doing well for the year, but they're about to get to that 78.6 level. Right now they're flirting in between there and the 61.8 level, which means that this may be a good level as far as to do a bearish position, in which if you own shares outright, you could simply do a long put. So again, looking at this chart, that's just what I wanted to show you as far as a good trading opportunity if you were still confused about why we use long puts and how it works. So now looking at the platform, the options table rather, you can see, so we talked about the left hand side, which is all about the calls, the bid and the ask. If you were doing a long put, you're simply on the right hand side now. And remember, the ask is for buying. So if we were to do a long put, we'd look at the ask, and let's say we want to do it right at the money. Right now, Chipotle is trading at $609.53. So we'll just round up to $610. And so that basically means that right here, $15 a share, this would cost us for one options contract $1,500 if we wanted to put in that trade. And just so I can follow through to show you exactly what I showed you in the other video, that's one contract. Boom shakalaka. As you can see, that's a max loss of $1,500. So that basically means what we paid out right with that $1,500 is the max that we can lose. And remember, this is a bearish position. So we are saying that Chipotle, going back to the charts really quick, let me delete this. Going back to the charts, we are saying that Chipotle is going to go down in this position. Okay, now looking at short puts, we're still on the put side, but now we're looking at the bid side. So still looking at that at the money put right now, you can see 610, 1380. So if we were to do a short put position, that basically means that we're going to collect $13.80 per share. If we do one options contract, we have 100 shares, so that just equals $1,300 and $13.80 is basically what we would be collecting for this particular trade. Also want to make mention again, remember, we are always looking for a tight bid-ask spread. Right now we see that this bid-ask spread is between $13.80 and $15. And remember that the bid-ask spread basically represents how much is it going to cost you to get out of this trade, and it also represents how liquid is the market right now. So we're going to have another video that breaks down the bid-ask spread, because if I talk to you right now, we would be here for another 5 minutes, and I said I was going to keep this video short. So that's basically how you do a long put and a short put. And remember, if you want to try out this trade, this is a ThinkorSwim platform. You're looking at a simulated account, so you can of course make your own paper trade account with ThinkorSwim. I'm gonna have a video that talks about the importance of paper trading and the reason why you need $0 to start trading right now. And it's because there are several brokers and firms that have platforms like this where you are able to paper trade and you're able to still, back test your different strategies and see what the market's doing with live market data, and you don't have to put money in the account. And while I'm talking about ThinkorSwim, they also have a really cool new feature that dropped recently that's called ThinkorSwim in Demand. You can use that feature to do exactly what we're doing here, which is back testing. So looking at the CMG, for example, where we're talking about October 2015, well, what you can do with that feature is actually go back to that very day and see, would my long put have worked in this particular trade if I had taken it on October 2015 and got out 2 months later? So it's a really cool feature that ThinkorSwim has, and I'm gonna have a separate video that talks and breaks down the ThinkorSwim in Demand, as well as another video that just talks about how you can start trading with ThinkorSwim using a paper trade account. All right, so now you understand what a long put is and what a short put is. So remember, typically we use long puts when we're trying to hedge our positions, but we can also use it when trading options when we typically want to take a bearish position. However, we want to buy outright. And short puts are just the opposite of short calls. We're collecting premiums, saying that we believe that this particular underlying is going to go up. However, that's the max that we can make, and we can theoretically lose unlimited. So hopefully now you guys understand what put options are and how we can use them when trading options. Now, what I do want you guys to do is make sure that you understand completely put options and call options, because in the next video, we're going to talk about how you can combine the two to create this ranging area. Yeah, it's going to be really cool, and you're going to love it, because that's when we can start to introduce how we're able to trade neutral when trading options. Until next time, make sure you talk in options.